Market volatility and an oil price spike are expected after strikes by the US on Iran. The US dollar may follow the oil price up. US business sentiment paints a negative picture for growth. And one Fed governor breaks ranks, saying a July rate cut is possible. That's coming up in our 5 Things in 5 Minutes on Monday, June the 23rd. And then in our deep dive interview, ANZ Group Chief Economist Richard Yetsenga assesses how long the US Fed can hold off lowering rates.
If there is an inflation impulse, it is likely to be temporary. And so I can understand maybe there's a chink in the Fed's armour with one official talking about the potential to ease in the near term.
But first, in 5 and 5 with ANZ, I'm Alex Tarrant, in for Bernard Hickey. A major escalation in the Middle East conflict saw the United States directly bomb Iran over the weekend, with retaliatory strikes by Iran on Israel. I spoke to ANZ senior commodity strategist Daniel Hines on Sunday evening about the situation.
We're going to have potential catastrophic consequences here for civilians in the region and the world at large, so our thoughts are with those people at the moment. Certainly for the oil markets, it's a pretty clear escalation of the conflict, and was something we highlighted last week in our scenario analysis. The escalation of the war brings with it really heightened risks around supply disruptions, essentially due to the potential for Iran to retaliate. Now, markets are going to be very, very jumpy to headlines over the next 24 hours, but certainly the initial reaction from Iran will be closely watched, and I think that initially will certainly result in some volatility across markets, so risk off tone, and certainly for oil, I think a pretty sizable jump in oil prices. I think the response from Iran will really frame whether we see a $10 jump in oil or if we see a 20 or 30 jump, because this really brings into play now supply across the region and, more importantly, the risk of disruptions in the Strait of Hormuz.
Number 2, West Texas intermediate prices closed Friday down slightly at $74.93 a barrel. Here's Daniel on how commodity markets may react.
We've seen other commodity markets really struggle amidst this backdrop over the last week, and I think that will be even heightened now that the threat of this broadening now across the region will clearly be an issue for the world. And so I suspect we would see defensive plays by investors really sought after. I would suspect gold would receive a bid amidst this geopolitical heightened tensions, and we would most likely see some weakness across some of the industrial commodities. But even more broadly across markets, it's going to rattle them pretty hard, and it's going to be a pretty volatile opening initially in Asian trading and then into obviously the New York and European markets opening.
Number 3, the US dollar index closed Friday down 0.2% at 98.71. ANZ head of FX research Marj Benzaman says while the US dollar still faces downside risk over the year, these events may see a near-term increase, particularly as the oil price rises.
Our view is that, yes, an extended conflict may cause a short squeeze in the dollar that could last for several days and weeks, and this will likely impact energy importers more than exporters. For example, that will probably impact the Euro area or Japan because they tend to be importers of energy, and so bigger prices create imported inflation for them. Here in Australia, we are net energy exporters, and so the FX impact might be lesser in terms of trade shock. In a risk-off scenario, a higher US dollar could also see tighter funding conditions.
And the Aussie dollar opens Monday at 64.51 US cents, down 0.48%. The Kiwi is at 59.62 US cents, down 0.53%. Number 4. On Friday, the S&P 500 closed down 0.22%. Gold will open the week at $3,385 an ounce, down 0.66%. On Friday, the Philadelphia Fed's business outlook for June painted a negative picture for the US economy, says ANZ economist Bansi Madhavani.
New orders fell, employment fell to its lowest since May 2020. Growth expectations were now less widespread, and expectations of future prices paid is rising. So bringing it all together, the survey is suggesting that activity remained somewhat subdued and growth optimism is reducing. That is consistent with our view that growth in the US is set to slow in the second half of this year.
Number 5. The focus around the US Fed last week has been Chair Powell's view that time is needed to assess the inflationary impact of tariffs. Fed Governor Christopher Waller broke ranks on Friday, though, saying rate cuts could come as soon as July.
But other members on the FOMC are perhaps more cautious, as we saw in the dot plot. For reference, 7 members projected no rate cuts this year, and 8 members projected cutting rates twice by 25 basis points this year. We are in the camp that September is when Fed will resume rate cuts. The FOMC will have 3 more sets of inflation, labor market, and activity data when it meets in September, and we think this will give it sufficient information on tariffs to make a decision on rates.
Bansi Madhavani there. Now in our deep dive interview, I asked ANZ Group Chief Economist Richard Yetsenga when the US Fed could cut rates, following Chair Jerome Powell's comment last week that it was a very foggy time for policymaking.
Well, it is to some extent a time of fog in the sense there's so many influences on the outlook which are non-traditional and non-economic. Obviously, we have this terrible conflict in the Middle East, which is perhaps the most acute focus, but also Russia-Ukraine in the background. Where tariffs end up is still an open question. What happens to the relations between countries as a consequence of that is still an open question. The Fed is still trying to work out how to quantify the policy DNA of this administration, which obviously tends to be less consultative than might have been the case historically. So I think the word fog is a good one. But US activity is weaker. The numbers have been softer. The outlook is softer. If there is an inflation impulse, it is likely to be temporary. And so I can understand maybe there's a chink in the Fed's armour with one official talking about the potential to ease in the near term. I suspect that sort of discussion will grow.
And they've talked about waiting for the data and wanting to see how tariffs will flow through to that inflation data in particular. Is this a matter of seeing that PCE number on Friday, or do you think another couple of months is still needed?
It's a very good question. I mean, our view is the Fed will move in September. We're now mid-June, so not that far away. I suspect what the Fed needs to see is a sequence of numbers which confirm that, yes, the one-off hit to prices is remaining exactly that. It's a one-off impulse to the level of prices rather than something that enters ongoing inflation. But I think the market will continue to flirt with this idea that, the Fed's got an itchy rate-setting finger and is at risk of moving imminently.
At the same time, you've been writing about how the USD has been losing some of its safe haven status and that downside risk for the USD. Is that all part of this parcel in terms of policy uncertainty, or is that more of a broader picture?
I think the dollar does lose from the nature of policy making in the US at the moment. The reserve currency has been termed exorbitant privilege, but it also takes some actions to generate that, and trying to use that exorbitant privilege in a way that benefits yourself really undermines it. And I think we're seeing that in the price action of the dollar. This is a period most people thought the dollar might go up because of its safe haven qualities, and actually it's been going down, particularly against the euro and the yen, and even against more cyclically sensitive currencies like the New Zealand dollar and the Australian dollar. The US dollar has been under pretty consistent gradual downward pressure for a couple of months now. I think this is the beginning of a pretty significant medium-term trend. We still have 3.5 years of the current administration to go, and it's clear that most of the impact of their policy measures, consider tariffs, consider tighter migration flows, to lower potential growth in the US. Yes, there is collateral damage for the world, but that damage is diffused across about 190 other economies, whereas the impact on the US is concentrated.
Richard Yetsenga there. I'm Alex Tarrenton for Bernard Hickey. That was 5 and 5 with ANZ for Monday, June the 23rd. Catch you tomorrow with further market reaction to the developing conflict in the Middle East.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.